Real estate investment practice problem using OneNote. Adjustable rate mortgage or ARM with a payment cap. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, down in the 5130 Adjustable Rate Mortgage ARM Payment Cap tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations, also in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon on the left-hand side, we got our information up top, calculations then on down below. We're looking at those adjustable rate or ARM type of mortgages once again. However, this time we don't have the rate cap, but a payment cap, which acts a little bit differently, a little bit more disturbingly in my estimation or calculation in any rate. We are going to be comparing, as always, whenever moving from the standard type of loan structure to the standard type of loan structure to get an idea of what the standard is and what the deviation then will look like. So starting out with the standard 30-year fixed $100,000 loan, years 30, 360 on the payments, 360 months. In other words, rate 10%, payment then calculated at, using the payment formula, the PMT, 877.57. That would give us our nice normal kind of amortization schedule where you got the payments all the same all the way down, the interest then reducing as we go, the loan amount reduction, the reduction going up, so the loan balance goes down, and then we got at the end of the loan a nice zero, fully amortized at the end of the time frame, the 360 periods. Now, it's a little bit more disturbing, as I say, sometimes when we're talking about this type of loan, this adjustable rate, with the new thing that's happening, that being the payment cap instead of the rate cap. Let's check it out. So we got the home value at the 100,000. We're not putting anything down because we're just really starting out basically at the 100,000 loan amount. So loan amount 100,000, years 30, payments 360. The initial rate we're going to say is 9%, and then we don't have any rate cap. We're not applying a rate cap here. We're applying an annual payment cap of the 7.5. So there's a cap on the payment, but not the rate. That's weird. Like, how does that work? We'll see. So then we got the margin is going to be the 2%. So if we look at our table, this is an overview of the table. Then we'll go back in. We'll go into a little bit more detail. But it'll start off kind of similar as the prior ARMs that we have taken a look at, in that they're going to be based on an index. The index is something that we don't know up front, but it's going to give us some idea of what's happening on the market. Then our rate is going to be some multiple of it. In our case, the margin, 2% increase over the index. So if we're starting out the loan, we can make projections about what we think the index is going to be. As the loan passes, then the index will be determined, and we can basically get our rate or do our calculations as we go. I like to think about it up front so you can think about scenarios when you're making the decisions about different loan structures, thinking about what's the best case, what's the worst case, and so on. But if we're given our data at the index at the 10% for year 2, 13% year 3, 14% year 4, back to 10% year 5, remember, the index could do anything. It just depends kind of on the market. And our margin is 2% above the index. Then in year 1, it's 9%. But wait, there's nothing on the index. That's because year 1 could be like a teaser rate, might not be tied exactly to the index. They might try to lure us in and then, hit us over the head in year 2 no, but they might have a lower rate. It might not be posted on the index. So in year 2, you got the 10%, which we increased by the margin to 12%. Index in year 3, 13%, increased by the margin of 2% to 15%. Year 4, 15%, increased by the margin of 2% to 17%. Year 5, 10%, increased by the margin of 2% to 12%. So no caps are involved there in terms of the rate. Then we can calculate our payment, which we'll do a little bit more detail shortly, but it's the same calculation we've seen in the past, calculating our rates based on calculating our payments based on these rates that have taken place. Then we're going to think about the caps on the payment. That's where the cap comes into play. And remember, we have a payment cap of 7.5%. So we are, in essence, going to take the lesser of 7.5% increase from the prior payment versus what the rate payment calculation was, the lesser of, in essence, the two of those. Now, this is funny because if it happens to be, as will be in this case, quite substantially will be in this case, the cap will be less than the amount of the payment we calculated. We're still calculating the rate and calculating the interest on the higher rate, even though we said we're only going to pay the lower amount. What does that do? That means the balance of the loan's going to go up, which is kind of weird because now you got like negative amortizing, which means you're not going to get that nice even loan structure that goes down to zero at the end of the 30-year time period. So that's why it's a little bit more disturbing to like an accountant or someone like me. If, I'm looking for something to balance out and like even out at the end, but it doesn't. It just, now you mess the whole thing's messed up, right? So it's a little bit more disturbing because it increases. But on the plus side, it could make it a little bit more even in terms of the payments, meaning the payment cap might give you on the payment cap versus a rate cap might mean that the increase in the payments will not be as substantial if there was an increase in the rate possibly. However, it results possibly in the increase or the negative amortization of the loan, which means you could actually owe more money than you originally, had on the loan, which might not be too bad given the fact that your home value probably goes up as well. So it might, take into consideration. So those are the kind of things that we want to be measuring in terms of the pros and cons. And then if you were comparing this versus like an ARM with a rate cap, you can take a look at and say, well, what if there was an increase in the rate in a similar fashion? And what would be the amount of adjustments on my payments between the two considerations? And then you can think about what would happen in terms of selling it. If you were to sell after 5 years, what would your loan balance be under the two considerations, and so on, and determine your internal rate of return and which of the two would be more appropriate types of loan structures if you had the two options available to you. So let's break this down in a little bit more detail. First, taking a look at calculating the payment structure. So this is just the first half of the table, the index, the rate, and then we'll calculate the payments based on those rates, and then we'll apply the caps to them. So the payment calculations, same as we've seen in the past, but we're just going to adjust them on a year-by-year basis. We got the negative PMT brackets, the rate, 9% for year 1, divided by 12 to get to the monthly rate instead of the yearly rate, comma, number of periods. We're going to think about it in years first. L5 referencing the data down here, which is the 30 years. It's absolute, meaning $ before the L and the 8, so that when we copy it down, it does not move down. And so then we're up here. Then we're going to subtract out N3, which represents that 1 right here. Then we're going to add hard-coded or typed in 1. Why would we do that? We took 30 minus 1 plus 1, in essence, getting us back to 30. Because when we copy that cell down, it'll be 30 minus 2 plus 1, or 29, which is what we want. So we're basically just have 30 here in a funny fashion so that we can copy it down nicely. Brackets, multiply times 12 to get to the number of months, in essence 360, instead of the years, comma, the present value. The present value would be the prior loan balance, which we can get up here. That would be the prior balance of the table, getting us to then that 804.62. Now, note that you can copy this down, this formula down. It would be this formula down right here, but it will be dependent on the ending balance over here. So then it's going to look funny. It would have zeros until you basically populate the ending balances, and then you copy down the ending balances, and they'll have that staggered type of relationship. So you can copy them down, but you got to remember that you'll have that staggered relationship until they actually work. So if I copied this formula down, it would be equals negative PMT, the rate now 12%, divided by 12, comma, number of periods, L5, same cell, representing that 30, minus now N4, different cell, moving from 1 to 2, so minus 2 plus 1, 28 years, or 29 years in essence, times 12, then to get to the year, to get to the months instead of years, comma, the prior balance, which would be now the 99,317, gets us the next calculation. So that's the calculation for the payments. Then we can think about the caps. Now the cap then, we can just kind of think through what the cap would be, and then we can apply a logic function to do it in Excel, the logic function being useful because if we were to run different calculations, best case, worst case scenarios, especially for a longer period of time, it would be nice if these caps could be automatically set to apply instead of us having to manually go through and think through them. But if you only got 5 years, you can kind of do that. You could say, okay, there's a 7.5% cap. That's where my cap comes into play, 7.5. So there's no cap in year 1. And then in year 2, we got this amount, 1,025.31, after the rate increased to 12%. But we said we can only increase by 7.5. So if I take the 804.62 times 0.075, that would be another 60 plus the 804.62. So it should go up to 864, and that's obviously less than this amount here. So we can get there a little bit faster by saying 7.5 plus 100%, or 1 plus 0.075 would be 107.5% in essence, times the 804.62. If that is less than this calculation, then we're going to be picking up the lesser of the two. Now, obviously, we have a scenario that goes up quite rapidly, and so we're going to end up always taking the cap here in this scenario. So the second one went from 1025.31 times 1.075. So that's going to bring us to, let's do that one more time. The second one was 864.97. This number times 1.075. That brings us to the 929.84, which is less than the 1,281.51. Therefore, we pick up that number. Taking that times 1.075 gets us to the 999.58, which is less than this 1,506. So we take the lesser of the two. The last one went down. So you'd say, you would think that would be in the range, but it's still not, because I take this times 1.075, and you're like, why would that be still less than this? It's because we had that negative amortizing. So now the loan balance went up, right? Even though so it's still an increase over the 7.5 of the cap because the balance is going up, which we'll take a look at shortly. So then if we think about that, we can also think about it as an if kind of logic function. You say, well, how can I put that in Excel? We could. Now, we'll just go over the idea quickly. We do this in Excel if you want to work on these formulas. But basically, remember the idea is that it's got to go up by the lesser of the 7.5% or this item here based on the rate. So if we know what this is, we could say the 1025.31, which is basically Q4, divided by the 804.62, that would be the increase plus 100% minus the 1 or 100% would give us to the percent increase, which would be 0.27 or 27%. So there's a 27% increase then. That's this whole portion. If that is greater than the referencing the 7.5 in the data set, the 7.5 increase, which this obviously is, then, so we go to the next argument, value if it's true. So if that is greater, then what are you going to do? Well, then you're going to apply the cap. The cap would be the R3, which is the prior cell, times those 7.5%, which would be this 864.97. If it's not true, meaning it's less than the payment cap, then we'll pick up this cell, the 125 in that case. Obviously, this one, we're applying the cap. If you do these formulas in there, again, it can be useful when you start running different scenarios in something like Excel. So once we have that, then we can look at the ending balances. And again, you'd probably be calculating the ending balances as you go. You can also check these ending balances on the Excel worksheets as you function, as you work out the amortization table. So for example, this 100,000, if we then change the payment to that 804.62 and we change the rate, then we're going to have, well, actually the rate will be the starting rate for the first one, but then we're going to have to do this with a new rate each time and a new payment basically each time here. So if we started off with the 100,000, one way we can calculate the ending balance is to say, okay, if I start off with 100,000, I'm going to look at 12 periods from there, 12 months out, using the information of the 9% and the payments at the 804. So we can do a future value calculation. That's how we'll do it this time. Future value brackets. We're going to take the rate. The rate is going to be that 9%. That's a yearly rate divided by 12, comma, number of periods. The number of periods is just going to be 12 months, because we're going 12 months from the prior balance. And then we'll say comma, and then we'll take the payment, which we calculated here to be the 804.62, and then we'll say comma, present value needs to be negative, and that would be in this case the 100,000, and that should give us the amount of the 99,317. If we were to do that again, going from here, the 99,317, and try to calculate the future value, meaning what will the balance be after having a new rate of the 12%, even though we have the 12% rate, we're not using the comparable payment, but rather the capped payment of the 864.97, resulting in the balance actually increasing, a higher balance than we started with. So that's going to be equal to the P4, which would be the rate. That would be the 12% divided by 12, comma, 12 periods or months, 12 months from the prior balance, in other words, comma, the payment is going to be that 864.97, and then comma, the present value negative of the prior balance, the 99,317. So again, you could copy this ending balance down. As you do so, then the payment calculation should populate, as well as the functions if you use the logic functions for the capped portions. Okay, we do that in Excel if you want to practice that in a bit more detail. Once we have that, then you can go into your amortization table and apply this out. So this is our standard amortization table. We would start off with the 100,000 up front as normal, and we would start off with the 804 basically as the payment, 804, and then we would calculate the interest based on the 9%. If that's all and we copied this down, then we'd have a normal kind of schedule that would fully amortize over the 360. But obviously in year 2, then we have this funny thing that happened. The 12% is now our new rate, but we're not even using the comparable payment. We capped it at the 864. So in year 2, now we're going to adjust the payments to 864, but the interest is being calculated at the 12%. So now we got the interest calculated at the 99317 times 0.12 divided by 12 would give us the 993 of interest, but we're only paying the 865. So that means we're paying less than the interest calculation, which means the balance of the loan's going up. So that's why we got this, what we would call negative amortization. So that now the balance of the loan is going up for this whole time frame during this period. That's where the funny kind of business happens. So this cap gave us a nice benefit in that it kind of restricted our payments to something that is we can calculate fairly clearly with a 7.5% increase, but it doesn't restrict the ending balance, so that if I was to have my loan could actually go up. So if I was to sell the home, then that's when it would come into play, because obviously then I'd have to pay off the balance of the loan and so on. So this ending balance, by the way, the 99,317 matches out to the 99,317 here. That 100,943 that we calculate should match out to the 100,943. Then in year 3, we're now increasing it. In year 3, as we can see, it went up to 15%, which would result in a payment of 1,281, but we capped it at 929 on the payment. So in year 3, then now we got the 930 on the payments that we capped, but but the interest is still calculated at 15%, 100,943 times 0.15 divided by 12. So that means the interest is at 1,262, but we're only paying 930 because we capped it. So now we have a substantial amount of negative amortization. The loan balance is going up during that time frame. It ends off at a higher balance at the 105,212. So there's the 105,212 there. Then it goes up to 17%, which would result in a payment at this point. And notice the payment is going up here, not just because of the rate, but because the ending balance is going up, right? We have a higher loan balance than we had before. So the payment should be at the 1,506 based on that rate, but we capped it at 999 in year 4. So now in year 4, about $1,000 on the payment, and I think what it was at 17. So like the prior balance here was 105,212 times 0.17 divided by 12. So the interest would be about 1,490, but we're only paying 1,000. So now again, the loan balance is increasing to 111,584, and then finally the rate goes down. The index went down, resulting in the rate going down to a fairly, not down to where it was, but fairly reasonable kind of level that you'd think might be in the range again, but it's still above where we started from. And even though we've been going up by 7.5% on the payments, we've been increasing the balance. So even then, we still ended up with a payment that should be higher than what we capped it at the 107.4. So we're still negative amortizing. We're back to 12% here, and we've been increasing our payment again, but the payment hasn't been increasing enough even to cover the interest, and therefore the loan balance has been increasing. So even when the rate goes back down, we have that cap in place. So now we're going to say 12%. This was year 5, was it? So now we've got the 1,007.5. If I take the prior balance of the 111,584 times 0.12 divided by 12, we get the 1,116. Again, we got that negative amortization ends off after year 5, 112,108. So that's going to be matching 112,108 that we calculated on the ending balance. Now, we stopped at 5 years. If we just apply that same amount for the 5 years all the way down, it would look something like this, and the loan would just keep going up, in this negative amortizing, which again might not be totally a bad thing if we can get the payments to go up in a way that we think we can cover them, and possibly then even if we have the option to pay off more, if we could, in the event that we could, then that might not, be bad, and then the home value would be going up, hopefully to compensate for the fact that the balance in the loans going up and so on. But for us, from just an accounting standpoint, the fact that it doesn't all neatly tie out, even with the rate changes after the 360 because of this negative amortization, is a little disturbing. It disturbs me. So I'm not sure if that's, should matter, but in any case, if you don't want, it's disturbing. In any case. So then if you were to add the pivot table, I won't go into how to do that in detail, but of course you can add a pivot table in this format because we've seen it in the past, and we'll do it in Excel if you would like to. That would give you that breakout of the payments, the interest, the loan, the minimum balance, giving you the added information with relation to the interest in particular, and giving you the year-by-year breakout that you can then use for decision makings, interest being useful because then that might have some tax implications as you make calculations based on that. And then, of course, you can do your IRR calculations, trying to compare possibly this type of loan with this kind of cap to possibly other loans, possibly loans that have a rate cap. Notice that every time, the whole point of the ARM loan is that the lender is shifting the risk of the increase in the rates to the borrower. And the reason that you want to do that is because then you might get lower rates and whatnot. So, but then if you hedge that back by saying that now you're gonna put a cap on it, whether it be a payment cap or a rate cap, then more of the risk has gone back to the lender, and the terms might not be as good. So that kind of play back and forth between those kind of things could lead you to then want to do these kind of calculations between different loans, between different loan terms, how long are you going to have the property for, and so on, and do your IRR calculations. Remember, when you're looking at this calculation in terms of the IRR, a significant factor will be the ending balance under different scenarios if you are in a situation where you have this negative kind of amortizing situation. So if you looked at the 30-year, for example, under this scenario, and we went all the way down to 30 years, which we stopped at 5, but if we assume the same kind of scenario for 5 years all the way down, and we were to do the IRR, the rate at which this series of payments would be 0, we get to the 12.33. Note that this one's a little bit unusual because even though we went 360 payments, we still had to include the ending balance here at 360 because the thing didn't go down to 0. So we still have a loan balance at the end of the 199,526 plus the 107.5. So that ending balance, that ending loan balance there. Now, we could do it out 5 years. If we did this out for 5 years, for example, at 60, or let's do it out, let's take it out for, I got 30 years. This one is going out 3 years. This should say 3 years. The 100,000, 3 years out. This would be our ending balance. We'd want to pick that ending amount up from the table at period 36. Here's our table. Period 36 on the amortization table is right there. 3 years out, 3 times 12. So we got this ending balance, which again is significant because it's going up, which was 105,212 plus that last payment of the 930. So we'd have an outflow if we sold of the 106,142 at the end. So the 106,141.42 about, there's the total. The IRR, or rate at which that flow would be zero, is 11.8. And then if you did it on for 5 years, just for another example, 5 years out, at 60, you got the flow at 60. You'd have to pick up the ending balance at 60 periods. So we can go down to 60. I'm going too far all the time. There it is. So now we have the ending balance 112,108 plus the 107.5. And that would be that last balance there, the 113,186. The IRR, or rate at which that series of payments would be zero, 12.7. Note that you can also calculate the IRR on a yearly basis, possibly from the table that we picked up, or by using the pivot table information, which can give you the year-by-year breakout. Here's the 5-year table that we got. If you did a similar kind of cash flow, you'd say, okay, now I got the 100,000 inflow. You've got the outflows now, which would be the payments at the capped amount. I'm taking the payments in terms of the outflow, which would be the 804.62 times 12, which would be the 9655, and do that for the payments that you had. And then this last one, we would take that last payment times 12 plus the ending balance, which would be the 1168.23 times 12 plus the ending balance of the 112,108 if we were to pay this thing off at the end of the time frame. I think I picked up the wrong number. Let's try 1074.55, the capped amount, times 12 plus the 112,108, which would give us the 125,002. And then if we took the IRR, the rate at which that series of payments would be zero, we get the 12.89. That's a little bit different than what we got for the 5 years on a monthly basis up top. The monthly basis you would think would be more accurate due to the fact that when we look at it on a yearly basis, this cash flow calculation, or this IRR calculation, is based on the idea that these payments are happening at the end of the period. If we put the periods in years, that would mean the end of the year, when in actuality they happened in 12 equal payments throughout the year. So it's a little bit of an approximation than if you do it on a year-by-year basis, but it gives you a good number to work with, and you can do it kind of when you construct your table, or possibly from pivot tables. So again, if you're using these kind of tools and you're looking into these kind of loans, then the idea would be to use these kind of tools and project out. You've got a lot more uncertainty into the future with regards to what the rates will be, what's going to be the impact on the caps. You could do some comparisons again between different types of loan structures that might have a rate cap versus a payment cap, and so on, and different time frames in terms of how long you might be holding on to the property, best case, worst case scenarios, and so on.